After studying this module, you will be able to learn the concept of value added and economic value added, understand the computation of economic value added, which is known as EVA, identify the various users of EVA, learn its implementation, procedure of economic value added, understand the pros and cons of economic value added, and know about EVA's implementation in India. In this module, we are going to discuss the concept of economic value added. Value added indicates the net value or wealth created by the enterprise during a specified period. The term value added means the market price of the output of an enterprise less bought in goods and services. Thus, value added is equal to value of production minus cost of material, power, etc. Henry Kesson defines value added as the market price of the output of an enterprise less the price of goods and services acquired by transfer from other firms. Thus, all employees, owners and government through taxation are recipients of the enterprise income. This is the total pie that can be divided among the various contributors of factor inputs to the enterprise in the production of goods and services. Value added is used to pay those who contribute to its creation. The value added statement shows the value created, added or generated and the distribution of it to interested group of employees, shareholders, promoters and the government. It puts profit into proper perspective vis-a-vis the whole enterprise as a collective effort by capital, management and the employees. It shows the wealth which the business has created and how it has been distributed among those who have created it. Value added statements or reporting is a modified version of the profit and loss account. Like profit and loss account, the value added statement reveals the operating performance of the company at a given point of time using both accrual and matching procedures. VAS aims to provide a figure or return to a larger group of capital and labor providers, other claimants or interested parties. The relationship between value added and the profit can be expressed algebraically as R is equal to S minus B minus depreciation minus W minus 1 minus dividend minus T, where R is equal to retained profit, S is equal to sales revenue, B stands for bought in materials and services, depreciation is equal to annual depreciation charge, W is equal to year's wage cost, I is equal to interest payable for the year, dividend is dividend payable for the year, T is equal to corporate taxes. Economic value added is an after-tax profit that exceeds the cost of capital or required minimum return on capital. It is computed by deducting the cost of capital from the after-tax profit. It is the best measure of the true profitability of an enterprise. Through EVA, it is relatively new to the financial press. Its conceptual and foundation is not. The term EVA was recently copyrighted by the consulting firm Stem Stewart and Company. EVA is a popularized by and registered trademark of the US firm Stern, Stewart and Company. Prominent US corporations such as IBM, Coca-Cola, Procter & Gamble, Johnson & Johnson, Microsoft, General Electric, LE AT&T and Indian companies such as Infosys, BPL, HLL, NIIT, TCS, Godrej, SOAPS, Ranbaxy Laboratories, Central India Limited have adopted EVA. Infosys Technologies is the first Indian company to report its EVA. The EVA framework developed by Stern Stewart and Company is gradually replacing the traditional measures of financial performance on account of its robustness and its immunity from creative accounting. It is an estimate of a firm's economic profit. It measures the value addition to an organization. EVA is the profit earned by the firm less the cost of financing the firm's capital. The idea is that value is created when the return on firm's economic capital employed is greater than the cost of that capital. Traditional performance measures such as NOPAT, EPS, ROI, ROE, etc. have been criticized due to their inability to incorporate full cost of capital. Thereby, accounting income is not a consistent predictor of firm value and cannot be used for measuring corporate performance. Value-based management system has gained popularity in academic literature in last 2 decades. One such innovation in the field of internal and external performance measurement is EVA. EVA is a financial performance measure based on operating income, after taxes, the investment in assets required to generate that income and the cost of investment in assets or weighted average cost of capital. The 3 elements used in calculating EVA are operating income after tax, investment in assets and thirdly, the cost of capital. The formula to measure EVA is equal to after tax operating income minus investment in assets multiplied by weighted average cost of capital. EVA is a rupee amount. If the rupee amount is positive, the company has earned more after tax operating income than the cost of the assets employed to generate that income. In other words, the company has created wealth if the EVA dollar amount is negative. The company is consuming capital rather than generating wealth. A company's goal is to have positive and increasing EVA. Let us now discuss the computation of EVA. To calculate EVA, a series of steps need to be followed. The common steps are exemplified here that may be modified due to the typical nature of business or processes where it has been used. Step 1. Collect and review financial statements. EVA is based on the financial data produced by traditional accounting system. Most of the data comes from either income statement or balance sheet, both of which are available from general purpose financial statements. Step 2. Identify the distortions and adjustments required to make it distortion free. Stern Stewart has identified around 164 potential adjustments to GAAP, commonly known as GAAP, and to internal accounting treatments, all of which can improve the measure of operating profits and capital. As financial statements are mandatorily prepared under GAAP, distortions will be there, and identification of distortions is an art that requires a sound understanding of EVA technicalities to identify and to adjust them as well. Step 3. Identify the company's capital structure. A company's capital structure comprises of all the money invested in the company either by the owner or by borrowing from outsiders formally. It is the proportions of debt instruments and preferred and common stock of a company's balance sheet. Stewart defines capital to be total assets subtracted with non-interest bearing liabilities in the beginning of the period. However, it can be computed under any one of the two methods. Direct method, by adding all interest bearing debts, both short and long term debts, to owner's equity. Indirect method, by subtracting all non-interest bearing liabilities from total liabilities or total assets. Step 4. Determine the company's weighted average cost of capital. Estimation of cost of capital is a great challenge so far as EVA calculation for a company is concerned. The cost of capital depends primarily on the use of funds, not the source. It depends on so many other factors like financial structures, business risks, current interest level, investors' expectation, macroeconomic variables, volatility of income, and so on. It is minimum acceptable rate of return on new investment made by the firm from viewpoint of creditors and investors in firm securities. Some financial management tools are available in this case to calculate the cost of capital. A more common and simple method is weighted average cost of capital. For calculating weighted average cost of capital, we have to know a lot of other issues such as number 1, components of capital employed like equity, debt, etc. Number 2, respected weight of various components into total amount of capital employed. Number 3, factors that affect the risk and return of various components in a capital structure. Fourth and lastly, stand-alone cost of all such components in a capital structure. The overall cost of capital is the weighted average of the costs of various components of the capital structure. The cost of each component of the firm's capital, that is debt, preferred stock or common stock which is known as equity, is the return that the investors must forego if they are to invest in the firm securities. The capital asset pricing model is a common method in estimating the cost of equity. The CAPM is stated in equation 1, which is RE is equal to RF plus beta multiplied by RM minus RF. Thus, CAPM postulates that the cost of equity, that is RE, is equal to the return on risk-free securities, that is RF, plus a company's systematic risk called as beta multiplied by the market premium RM minus RF. Risk premium is associated with the specific risks of a given investment. Step 5. Calculate the company's net operating profit after tax, commonly known as NOPAT. NOPAT is a measure of a company's cash generation capability from recurring business activities and disregarding its capital structure. NOPAT is derived from net operating profit, commonly known as NOP, simply by subtracting calculated taxes from NOP. But adjustments should be made to the accounting profit to convert it into economic profit. Operationally defined, EVA is the difference between the net operating profits after taxes and capital charges, that is, cost of capital employed or the product of capital employed with the difference between return on capital employed and cost of capital employed. Therefore, EVA is equal to NOPAT minus capital charge, where capital charge is equal to WACC multiplied by CE, and WACC is equal to weighted average cost of capital. CE stands for capital employed. NOPAT is equal to profits after depreciation and taxes but before interest cost, or EVA is equal to capital employed multiplied by return on capital employed minus cost of capital employed. WACC is equal to cost of debt multiplied by total debt divided by total debt plus CMVE multiplied by 1 minus tax plus cost of equity multiplied by CMVE divided by total debt plus CMVE, where CMVE stands for company's share price multiplied by total shares outstanding. The relationship between the value of the EVA indicator and investors' behavior is: number 1, if EVA is greater than 0, the relevant company or its departments gain more than weighted average value of the capital, therefore value creation occurs. The positive value of EVA value shows an efficient use of the capital and represents an index of company value increase. 2. If EVA is equal to 0, the company or its departments gain exactly as the capital cost level, meaning that the relevant company has the same value as in the moment investments were made in it. This is a notable feat because the company capital owners recovered their investment and compensated the assumed risk. 3. If EVA is less than 0, the company or some of its departments do not recover the capital cost. Investors could have obtained a higher profit elsewhere with the same risk. The negative value of the EVA indicator shows an inefficient use of capital and a decrease of company value. EVA will increase due to the 3 reasons, which are: number 1, operating profits can be made to grow without employing more capital, that is greater efficiency. Number 2, additional capital is invested in projects that return more than the cost of obtaining new capital, that is profitable growth. Number 3, capital is curtailed in activities that do not cover the cost of capital, that is liquidate unproductive capital. Let us now discuss utility of economic value added statement. Economic value added statement is useful to the number of user groups. Let us discuss these. First are investors. While accounting profit measures such as earnings per share, return on equity, return on assets and return on investment are among the most commonly used performance measures. They are often criticized for not taking into consideration the total cost of capital and for being unduly influenced by accrual-based accounting conventions. In contrast, economic value added, the difference between after-tax operating profits and the total cost of capital, is promoted as a measure of a company's real profitability. Since value is a primary concern to investors, proponents claim that EVA is the only performance measure that ties directly to stock's intrinsic value. It has also been generally asserted that stock prices and EVA show remarkable tendency to move up and down together. Number 2, creditors. Although investors' investment objectives differ from creditors' objectives, both attempt to maximize their utility, and that utilities are in turn a function of two variables, expected return and risk attached to the return from any investment. Information requirements of loan creditors are essentially the same as that for equity investors. Management and employees. EVA is an important technique to measure performance. It has become more popular in comparison to traditional approach. More explicitly, EVA measure gives importance on how much economic value added is for the shareholders by management for which they have been entrusted with. EVA is exceptional from other traditional tools in the sense that all other tools mostly depend on information generated by accounting. Employee compensation is arguably the integral part of EVA. In most corporations today, bonuses are commonly associated with achieving the annually negotiated budgets. Therefore, the incentive is for the manager to negotiate a budget that can easily be achieved. Incentives under the EVA system attempt to make managers into owners by directly linking their bonuses to the increase in EVA. Thus, a manager is rewarded for making business decisions that increase the value of the company in the future. This incentive plan will shift the focus of management to the long term rather than focusing on short-term benefits without giving any regard to the long-term ramifications. EVA can be useful in predicting the level of future income from employment. Government. Once a sound framework for EVA is in place, developing country governments working in collaboration with private sector itself and with developed partners can maximize economic value added and job creation from private sector investment by establishing priorities and focusing scarce resources on specific industries. Value added information from firms forms a useful function in macroeconomic measurement and forecasting from government's point of view. Measuring EVA is not enough. Rather, one needs to adopt it and implement it. Implementing EVA is a 4-step process, also called as the 4M process, and these M's are: number 1, measurement; number 2, management system; number 3, motivation; and lastly, number 4, mindset. The first step is to measure EVA. In this step, 3 parameters are taken care of, namely, number 1, create system facilitating proper resource and asset allocation and transfer pricing. Number 2, Create EVA stretch goals and benchmark them. Number 3. Define EVA of business units, strategic groups, project teams. The next step is to provide management tools using EVA. This includes number 1. Refine capabilities and investing technique to ensure only value adding projects are taken up. Number 2. Identify EVA drives and operating measures. Number 3. Report EVA of the business divisions, teams or projects on a regular basis. The third step is to motivate people on the basis of EVA. This step includes number 1. Adopt an EVA based on incentive compensation and appraisal system. Number 2. Create EVA stretch goals and benchmark them. The last step is to modify the mindset. This includes number 1. Train people in the organization in EVA and value building concepts. Number 2. Educate them to focus on one objective, that is maximizing EVA. Let us now discuss the advantages of economic value added. EVA, economic profit and other residual income measures are clearly better than earnings or earnings growth for measuring performance. EVA is conceptually the same as residual income measure, long advocated by some accounting scholars for its managers as well as value for shareholders. EVA may also highlight parts of the business that are not performing up to scratch. If a division is failing to earn a positive EVA, its management is likely to face some pointed questions about whether the division's assets could be better employed elsewhere. EVA sends a message to managers: invest if and only if the increase in earnings is enough to cover the cost of capital. For managers who are used to tracking earnings or growth in earnings, that is relatively easy message to grasp. Therefore, EVA can be used down deep in the organization as an incentive compensation system. It is a substitute for explicit monitoring by top level management. Of course, if a junior manager's compensation is tied to their economic value added, then they must also be given the power over those decisions that affect EVA. Thus, the use of EVA implies delegated decision making. EVA makes the cost of capital visible to operating managers. A plant manager can improve EVA by number 1. Increasing earnings, or number 2. Reducing capital employed. Therefore, underutilized assets tend to be flushed out and disposed of. Working capital may be reduced or at least not added to casually. Introduction of residual income measures often leads to surprising reductions in assets employed, not from one or two big capital disinvestment decisions, but from many small ones. EVA lets the business managers realize that even assets have a cost and hence stock won't be lying idle. The firm will start using JIT, that is just in time method, and change the way they connect with their suppliers and have them deliver raw material more often. Moving on further, let us now discuss limitations of EVA. EVA does not involve forecasts of future cash flows and does not measure present value. Instead, EVA depends on the current level of earnings. It may therefore reward managers who take on projects with quick paybacks and penalize those who invest in projects with long gestation periods. Think of the difficulties in applying EVA to a pharmaceutical research program where it is typically 10 to 12 years to bring a new drug from discovery to final regulatory approval and the drug's first revenues. That means 10 to 12 years of guaranteed losses even if the managers in charge do everything right. Similar problems occur in startup ventures where there may be heavy capital outlays but low negative earnings in the first years of operation. This does not imply negative NPV so long as operating earnings and cash flows are sufficiently high later on. But EVA would be negative in startup years even if the projects were on track to a strong positive NPV. The problem in these cases lies not so much in EVA as in the measurement of income. The pharmaceutical R&D program may be showing accounting losses because the accounting principles require that outlays for R&D be written off as current expense. But from an economic point of view, the outlays are an investment, not an expense. If a proposal for a new business forecasts accounting losses during a startup period, but the proposal nevertheless shows positive NPV, then the startup losses are really an investment. In short, EVA and other measures of residual income depend on accurate measurement of economic income and investment. Applying EVA effectively requires major changes in income statement and balance sheet. Let us now summarize what we have learnt in this module. Traditional approaches to measuring shareholders' value creation have used parameters such as earnings capitalization, market capitalization, and present value of estimated future cash flows. Extensive researches have now established that it is not earnings per se, but value that is important. Profit maximization as a concept is age old. Wealth maximization is matured and value maximization is today's wisdom. A new measure called economic value added is increasingly being applied to understand and evaluate economic performance. During the 1990s, value-based management has made a strong entry in assortment of management tools in the form of EVA as marketed in particular by Stern Stewart and Company. Since then, it has successfully taken an important place in corporate world. The central idea of EVA is subtracting the cost of capital from the firm's profits to measure the economic additional value produced by the firm to its owners over the weighted cost of the capital employed. It is well accepted from both sides of the coin, that is, owners and management. Owners are happy to see the amount of value added and management is happy to get reward proportionately. The number of companies that have turned to economic value added as a new and modified way to gauge corporate financial performance is going up. Indian corporate world is also recognizing the importance of EVA. EVA has enabled management to link key decisions to shareholders' value. EVA has some inherent limitations as well. Major limitations are generated due to conventional accounting system that produces time-barred data. Thus, calculating true EVA becomes a challenge. EVA has both advantages and limitations. Thus, using EVA only is no case a good decision. Rather, it should be used with other to take decisions more effectively.